Imagine waking up one morning, looking at your bank account and realizing that the most important thing happening to your money is not the balance. It is the pattern that is the part most people miss. They look at whether the money is still there, they look at whether the deposit arrived, they look at whether the withdrawal cleared. They think the system is only asking one question: do you have the money or not? But modern financial systems do not just look at balances. They look at behavior, they look at deposits, they look at withdrawals, they look at timing, they look at repetition, they look at whether this month looks different from last month, and whether this year looks different from the 10 years before it. And when you are retired, when your life is no longer built around a predictable paycheck every 2 weeks, your financial life naturally starts to look irregular. You may receive Social Security every month, you may receive a pension, you may take money from an IRA, you may sell a car, you may help a child with a down payment, you may move money from savings to checking for a roof, a medical bill, or a trip to see grandchildren to you. That is just life. To an automated system, it can look like risk. That is why the number $10,000 matters so much. It is not because $10,000 is a large amount of money in the modern world. It is because the system still treats it as if it were. And starting in 2026, that number is going to matter in a different way for many retirees, not because the basic idea is new, but because the technology, enforcement priority, and data analysis around it are becoming much more powerful. This is not about panic. Panic is not useful. Panic causes bad decisions. This is about understanding the machine you are operating inside. If you do not understand a system, you will tend to be surprised by it. And when money, government reporting, retirement savings, and automated risk systems intersect, being surprised can be very expensive. Let me tell you about Patricia. Patricia is 71 years old. She is a retired school teacher in Ohio. She spent 35 years teaching children how to read, how to write, and how to think clearly. She is not a criminal. She is not hiding money. She is not trying to cheat anyone. She is simply managing her savings the way she has always managed them. Every month, her Social Security payment arrives in her checking account. Every few months, she moves money from savings to checking because real life requires it. A roof needs repair. A medical bill comes in. A family trip comes up. A grandchild needs help for decades. Patricia did these things without worrying that the way she moved her own money could create a problem. But under the newer enforcement environment surrounding bank reporting and the $10,000 threshold, Patricia can become visible to the system in a way she never intended. Not because she did something wrong, because her activity can be interpreted by software before it is understood by a human being. That is one of the great principles of modern life. When systems become automated, they get faster, broader, and less forgiving. A human being might say, this is a retired teacher helping her family. A system might say, this is an unusual flow pattern. A human being might ask for context. A system starts with detection, and once you are detected, you are in a different part of the machine, so we have to go back to the beginning. For decades, banks in the United States have been required to report certain transactions to the federal government. The foundation of this came from the Bank Secrecy Act of 1970. The purpose was understandable. The government wanted to detect money laundering, drug trafficking, tax evasion, and other serious financial crimes. That is the way most powerful government systems begin. They are created to solve a real problem. But over time, systems expand, the world changes. Prices rise, technology improves, enforcement becomes easier, and the original line that was drawn for one purpose starts catching people who were never the intended target. The line in this case is $10,000. Banks had to file a currency transaction report whenever a customer deposited or withdrew $10,000 or more in cash. That sounds simple. But the problem is that the number has not moved. It has been sitting there for more than 50 years. $10,000 in 1970 was a very different amount of money from $10,000 today. In 1970, that was serious money. It was not a normal amount for an ordinary household to move casually, adjusted for inflation. That amount would be roughly $80,000 in today's purchasing power. But the threshold stayed at $10,000. And that is where the system begins to catch the wrong people. As wages rose, home prices rose, medical bills rose, car prices rose, funeral costs rose, and retirement account balances rose, more ordinary people began crossing a threshold that was originally designed for very different behavior. This is not a small detail. It is the center of the problem. A rule that does not adjust to reality eventually stops measuring what it was meant to measure. In 1970, a $10,000 cash movement could reasonably stand out. In 2026, a retiree can cross that line because of a car purchase, a home repair, a medical bill, a required minimum distribution, an inheritance, a family gift, or a downsizing move. The number stayed the same, life did not. And when life changes but the system does not, ordinary people get pushed into categories that were not designed for them. There is another layer beyond the currency transaction report. It is called a suspicious activity report. Banks can file these reports when they believe a customer is behaving in a way that could indicate illegal activity. The important word is could, not does. Could, that distinction matters because the financial system does not need certainty to start reporting. It needs suspicion. And suspicion in a computerized environment is often produced by patterns. One of the patterns that can create trouble is called structuring. Structuring means deliberately breaking up a larger transaction into smaller transactions to avoid the $10,000 reporting requirement. If someone has $27,000 in cash and intentionally deposits $9,000 today, $9,000 tomorrow, and $9,000 the next day for the purpose of avoiding a report, that is not clever. That is dangerous. It can be treated as a federal crime. The money itself does not have to be illegal for the behavior to create a problem. That is what many retirees do not understand. They believe that if the money is clean, the pattern cannot hurt them. But systems do not begin by judging your character. They begin by judging the pattern, and many older Americans were raised with financial habits that now collide with modern reporting rules. Some grew up with parents who distrusted banks. Some lived through periods when cash felt safer. Some like to keep money at home. Some prefer smaller transactions because they feel more controlled. Some do not like having all their money moving through one channel at one time. Those habits may feel conservative, they may feel careful, they may feel responsible, but if they create a pattern of deposits or withdrawals just under reporting thresholds, the system may see something very different. It may see evasion, that is the danger, not the intention, the interpretation. There have already been real cases in which ordinary citizens and small business owners had their accounts seized because their deposit patterns looked like structuring. In some of those cases, no criminal charges were filed. The money was legitimate. But the account holder still had to fight to get the money back. That is the part that people find hardest to believe until it happens to them. In a civil asset forfeiture system, the government can seize money based on suspicion that it is connected to wrongdoing, and the burden can shift heavily onto the person whose money was taken. That person may have to hire a lawyer, they may have to produce documentation, they may have to wait months or years for a wealthy person. That is painful for a retiree on a fixed income. It can be devastating. Now move that older reporting structure into the 2026 environment. The basic law around the threshold is not the only issue. The greater issue is what is happening around it. The IRS has received significant new resources. And a major focus of modern enforcement is data analysis. That means the government does not have to rely only on old-fashioned audits or random human review. It can use more advanced tools to compare reported income, deposits, distributions, transfers, and patterns. The system can see more, it can connect more, it can flag more. That does not mean every flag leads to an audit. It does not mean every report leads to a seizure. It does not mean retirees should live in fear every time money moves. But it does mean the old habit of saying, I have nothing to hide, so I have nothing to worry about, is not enough. In a complex system, innocence and clarity are not the same thing. You can be innocent and still unclear. You can be honest and still undocumented. You can be doing something normal and still look abnormal to a database. That is why seniors have to be more careful than they were years ago. The first place this becomes important is retirement income. Many retirees receive predictable deposits from Social Security, pensions, or retirement accounts. Those payments may be ordinary and properly reported. But retirees also often make larger withdrawals from IRAs, 401(k)s annuities, or savings accounts to cover bigger expenses. A required minimum distribution can easily cross $10,000 depending on the size of the account. A liquidation to pay for medical costs or home repairs can cross it. A transfer from one account to another can look large even when the money is just moving from one pocket to another. If the tax reporting and documentation are clean, the issue may be easy to explain. If the records are incomplete or confusing, the same transaction can become a source of scrutiny. This is one of my core principles. When the environment becomes more complex, the cost of being disorganized goes up. Being right is not enough. You have to be able to show why you are right. The second place the rule touches retirees is family gifting. Retirees often want to help children and grandchildren while they are still alive. They want to help with college, they want to help with a down payment, they want to help after a divorce, a medical event, or a business setback. There is nothing inherently wrong with that, but large gifts need to be documented. Transfers need to be understandable. If money moves repeatedly between family members, especially in cash or in irregular amounts, the system may not see love. It may see unexplained flow. That is the cold nature of systems. They do not know your family history. They do not know that the $15,000 went to a grandson trying to buy his first home. They do not know that the $12,000 deposit came from selling a car to a neighbor. They do not know that the money was an inheritance from an estate unless the paperwork makes it obvious. The third place this becomes important is home sales and inheritance. For many seniors, the largest financial events late in life involve real estate and estate transfers. A person sells a home, downsizes, moves closer to family, or receives proceeds after a spouse passes away. These are normal life events, but they can involve large lump sums when hundreds of thousands of dollars move into or out of an account. Reporting and documentation become unavoidable. The money may be completely legitimate, but the system still has to process it. The question becomes whether your financial life tells a clear story. Where did the money come from? Where did it go? Was it taxed properly? Was it exempt? Was it inherited? Was it from a home sale? Was it a retirement distribution? Was it a gift? Every large movement should have a clean explanation, and the explanation should exist before anyone asks for it. The fourth place this matters is everyday senior finance. This is where many people underestimate the risk. A retiree sells furniture, jewelry, collectibles, or a car. A retiree receives rent. A retiree temporarily holds money for a family member. A retiree deposits cash from an estate sale. A retiree helps an adult child by moving money in and out of an account. Each event may be innocent, but combined they can create a pattern, and systems are built to read patterns. That is why it is dangerous to think only in individual transactions. You have to think in sequences. What does this look like over 30 days? What does it look like over a year? Does it match your tax return? Does it match your documents? Does it match your normal income? Does it look like family support? Or does it look like unexplained cash flow? This is not about being afraid of your own money. It is about understanding how your money appears to the system. When a bank files a currency transaction report or suspicious activity report, that information goes to the Financial Crimes Enforcement Network, a bureau of the Treasury Department. From there, the data can be available to law enforcement agencies, including the IRS. The IRS can use its own systems to decide whether a person or account deserves closer review. That review can be mild, such as a letter asking for documentation. It can be more serious, such as a formal audit. And in more extreme cases, suspected structuring can lead to civil forfeiture or criminal investigation. Most people who are reported under the Bank Secrecy Act never hear anything about it. That is important to understand. The system produces a huge number of reports. Most are never acted upon. Most ordinary people will not receive a call or a letter every time a report is filed. But the risk is not zero, and the risk is not evenly distributed. The person with clean records, clear explanations, and professional guidance is in a much better position than the person who says, "I do not remember, I did not write it down, and I thought it did not matter." It matters especially for retirees, because when you are retired, time and liquidity matter. If money is frozen for weeks or months, you may not have a second paycheck coming in to replace it. If you have to hire a lawyer, that may cut into savings you spent decades building. If an audit expands into other areas, it can create stress at precisely the stage of life when you deserve peace. So what is the rational response? Not fear, a plan. The most important habit is record keeping. That sounds boring. It is also one of the most powerful protections you have. If you sell a home, keep the closing statement. If you receive an inheritance, keep the estate documents and bank records. If you liquidate retirement funds, keep the statements. If you make a family gift, write down the date, the amount, the recipient, and the reason. If you sell personal property, keep a bill of sale or written note. A notebook is better than memory. A folder is better than scattered papers. A spreadsheet is better than guessing. The system runs on records. You should too. The goal is not to create bureaucracy in your own life. The goal is to make your financial story easy to prove. When something can be explained clearly, it becomes far less threatening. A $25,000 deposit with no documentation can raise questions. A $25,000 deposit with a closing document, settlement statement, or estate transfer record tells a story. The second habit is working with someone who understands retirement and tax reporting. Not every tax preparer understands the specific way retirement income, required distributions, gifts, inherited accounts, home sales, and bank reporting interact. A good CPA, enrolled agent, or tax attorney can help you make sure your transactions are structured legally and documented properly. That does not mean you need a professional for every small movement of money. It means that when you are dealing with meaningful sums, you should not guess. One of the worst financial habits is trying to save a small fee by taking a large unknown risk. The third habit is avoiding anything that looks like structuring. This is very simple. If you need to move a large, legitimate amount of money, do not break it into smaller pieces just to avoid a report. A clean $15,000 deposit with documentation is usually far less dangerous than 2 or 3 deposits just under $10,000 with no clear reason. Many people get this backwards. They think the report is the danger. Often the attempt to avoid the report is the greater danger. Let the normal report happen, keep your documents, be able to explain it. The report itself is not an accusation, it is a mechanism. Trying to evade the mechanism can turn an innocent act into a serious problem. The fourth habit is understanding your rights. If the IRS contacts you about bank transactions, do not panic, but also do not ignore it. You have the right to representation, you have the right to respond in writing. You have the right to ask what is being questioned. You have the right to bring in someone who understands the process. One of the worst things a person can do is respond emotionally to a government inquiry. Fear makes people over-explain. Anger makes people careless. Silence makes deadlines pass. A principle-based response is different. Read the notice. Preserve documents. Contact a qualified professional. Answer the question asked. Do not volunteer confusion. Do not guess. Do not fabricate. Do not assume the person reviewing your case knows your life. Make the facts clear. The fifth habit is making sure your family understands the rules. A lot of senior financial risk comes from family help. An adult child deposits money into a parent's account. A parent moves money for a child. A grandparent gives cash gifts. A relative temporarily uses an account for convenience. Everyone may be acting with good intentions, but good intentions do not erase bad patterns. If money is moving between family members, write it down, use checks or wires when appropriate. Create a paper trail, avoid cash when a clear transfer record would be better. If a family member is managing money for an older parent, make sure the legal authorization is in place. That means power of attorney or similar documentation when needed. This protects the senior. It also protects the family member helping them. Without proper authorization, even helpful actions can look suspicious later. There is another issue that matters deeply: cognitive decline. As people age, some will naturally need more help managing money. That is not a moral failure, it is part of life. But it changes the risk profile. Automatic transfers, repeated withdrawals, unclear deposits, or family members moving money without proper records can create confusion. And confusion is dangerous in a reporting system. If you are helping a parent or grandparent, your job is not just to move the money. Your job is to make the record clean: date, amount, source, purpose. Recipient. Those 5 elements can prevent a lot of pain. Seniors are also vulnerable to scams that use the banking system. Scammers often create urgency. They tell the victim to withdraw cash. They tell them to keep it secret. They tell them to send money in amounts that may be deliberately structured to avoid attention. This creates a double injury. First, the senior loses money to a criminal. Then, the transaction pattern may look suspicious to the bank or government. If someone pressures you to move money quickly, secretly, or in an unusual way, stop. Slowing down is one of the best forms of protection. Talk to a family member. Talk to a banker you trust. Talk to a financial professional. If the person asking for money says you must not talk to anyone, that is the signal that you must talk to someone. The system is imperfect, but scams are real. You need protection from both. There is also a broader question here about privacy and fairness. Many honest retirees feel insulted when they learn how much financial activity can be reported. They feel that after a lifetime of working, paying taxes, saving responsibly, and following the rules, they are being treated like suspects. That feeling is understandable. There is a real tension between fighting financial crime and preserving financial freedom. Governments want visibility. Individuals want privacy. Banks want protection from liability. Retirees want access to their own money without being treated as if they did something wrong. That tension is not going away. So the practical question is not whether the system is emotionally satisfying. It is how to operate wisely inside the system that exists. A principle I use often is this: do not confuse the world you want with the world you must deal with. You may believe the $10,000 threshold should be indexed to inflation. You may believe civil asset forfeiture should be reformed. You may believe bank reporting should have clearer limits. Those are legitimate views. But while those debates continue, your money still has to move through the current system. So protect yourself now. At the same time, seniors have a voice. Policies are not permanent laws of nature. They are made by people and can be changed by people. If you believe the system is unfair, you can raise that concern with elected representatives. You can support organizations that advocate for financial privacy and reform. You can tell your own story, but personal protection comes first. The direction of travel is clear. Financial systems are becoming more data-driven. Government agencies can analyze more information with less manual labor. Banks can flag more patterns. Digital records can be cross-referenced faster, even when aggressive proposals are scaled back. The general movement toward more data collection and more automated analysis remains. That is why the habits I am describing are not temporary. They are permanent features of responsible financial management in the modern world. Keep records, avoid suspicious patterns. Use professional guidance for large transactions, communicate with family, understand your rights. Slow down when something feels urgent or secretive. These are not complicated principles. They are simple, but simple does not mean easy. Many people only learn them after they have already been flagged. You do not need to be one of them. Think about Patricia again. She does not need to live in fear of her bank account. She does not need to stop helping her family. She does not need to avoid using her own savings. She does not need to become an expert in every provision of bank reporting law, but she does need a system. If she sells a car, she keeps the document. If she gives money to a grandchild, she records it. If she takes a large retirement distribution, she makes sure it is properly reported. If she moves a meaningful amount of cash, she understands that breaking it into smaller pieces may create a bigger problem than moving it cleanly. If she receives an IRS letter, she calls a professional before responding. That is not fear, that is preparation. And preparation is one of the most valuable habits in money, because money problems usually become worst when they combine surprise, pressure, and confusion. Remove the surprise by learning the rules, remove the pressure by planning in advance, remove the confusion by keeping records. The $10,000 rule is real, the reporting system is real, the increased data analysis is real. The risk to seniors who do not understand how their financial behavior can look to an automated system is real, but your ability to protect yourself is also real. You work for your money, you saved it, you paid taxes, you built a life, you deserve to manage your retirement with confidence, not with constant anxiety. Confidence does not come from pretending the system is simpler than it is. It comes from seeing the system clearly and acting before it acts on you. So before the next large transaction, do the boring thing that protects you. Write it down, save the proof, ask the question, move the money in a clean way. Talk to the people who need to understand it. And if someone you care about is over 60 and still believes the bank rules work the way they did decades ago, tell them the truth gently but clearly. The rules around the $10,000 threshold were built in another era. The threshold did not keep up with inflation. The technology around it became much stronger, and ordinary retirees are now living in the gap between an old number and a modern surveillance system. That gap is where mistakes happen. That gap is where innocent people get flagged. That gap is where disorganized records become expensive. But it is also a gap you can manage if you understand it. The most dangerous person in this system is not the criminal who knows the rules. It is the honest retiree who does not. Because the criminal plans around the system, the honest person assumes the system will understand them. Systems do not understand you unless your records explain you. That is the lesson. Not that every transaction is dangerous. Not that every report is an audit. Not that the government is coming for every retiree who moves money. The lesson is that in a world of automated financial oversight, clarity is protection. If your money has a clean source, a clean purpose, and a clean record, you are in a much stronger position. If your money moves in unexplained patterns, especially around the $10,000 threshold, you are taking unnecessary risk. Do not make the system guess. Do not make a reviewer reconstruct your life from fragments. Do not let an innocent pattern look like an intentional evasion. When you manage money in retirement, the goal is not only to preserve the dollars, it is to preserve control. Control over timing, control over explanation. Control over access, control over decisions, control over the records that prove what really happened. That is how you keep a financial system from turning your normal life into a problem. And that is why this matters now, because the number did not change, but the world around the number did. And when the world changes, the person who survives best is not the person who complains first. It is the person who adapts fastest, calmly, rationally, and with a clear set of principles.